Hello, this is an introduction to options, part 1. So we're going to discuss, first of all, what is an option? Then we're going to look at an example, a second example, talk through some terminology, and then look at the value of an option at the expiry of that option and the profit of that option at expiry. So first of all, what is an option? Well, an option gives the holder the right, but not the obligation, to either buy or to sell a given quantity of an asset on or before a given date at a given price that has already been agreed upon today or previously if it's already an existing option. Now, the asset upon which the option buyer holds the right is called an underlying asset. It could also be an option seller. We'll talk about that. And the right to buy the underlying asset is a call option, whereas the right to sell the underlying asset is called a put option. So let's say you intend on spending your upcoming summer holidays next July in the wonderful town of Happyland, Saskatchewan. Check it out. It's a real place. Now, a room for the month would cost you $475 if you were to book it today. However, you will only know for sure if you're going to go by next May, sometime May or before then. But by then, the cost for a hotel room may range from $300 to as high as $1,000. However, you can purchase the right to book a room, and that right, of course, would expire in May, and you could then book that room for $500. However, purchasing that right to guarantee the room at $500 would cost you $50 today. So let's look at the terminology here. Starting with the right to book a room. So if you have a right to book the room, that means you have the right to buy, essentially, the use of that room, and that is a call option. Now, the $500 that you would pay if you exercise that right, that is the price that you would pay for the asset, which is the use of that room. That is the exercise price, often called the strike price. The right that you are purchasing would expire in May. So that date of the option expiry is the maturity date or the expiration date. And then you also have the $50 that you're paying today. Well, that is the cost or the price paid for your option. The word for that is called the option premium. Sorry, that flashed away a bit quickly. And the $475, what is that? Well, that is how much it would cost today, and that is simply today's price, often called the spot price. And because you purchased the right, you purchased the option, that means you are the buyer of the option. You have a position that's called a long position. So you own the option. Now, where did you get the option from? Well, who sells you the option? It would be the hotel that's selling you the option. So the hotel has a short position. In other words, if you decide to exercise your option, you buy the room for July for a price of $500 a room, the hotel has to offer it to you. Even if the going rate for a hotel room would be $1,000, you have bought the option that you can exercise at $500 a room. So that's how that would work. So let's say you purchase this call option and you have until May, which is the maturity date or expiry date, to decide whether you're going to book the hotel room at a price of $500 or an exercise price. So let's look at the two extreme scenarios. Those are the extreme values that that room could be. So in the first scenario, in May, the price for a room for July would be $300. And in scenario 2, by May, the price for a room in July would be $1,000. So what is the value of the option that you paid $50 for? That's the option premium that you paid. Now, under scenario 1, you would have the right to buy the room for $500. However, the room is only worth $300. So what is that worth? Well, I mean, if you've bought the right to buy the room. If you have the obligation to buy the room, of course, then of course you are losing money. You would actually have to pay $500, but the room is only worth $300, so you'd be losing $200. But because we have an option, you have a right to buy the room. So that means this option cannot go under the value of 0, and that's exactly the value of that option because you're not going to use it. You're going to throw it in the garbage, basically. Now, the second scenario, you have the right to buy the room or to rent the room for $500, but the room is worth $1,000. Now you realize that your option has good value because you can buy the room for 1,000, or sorry, you can buy the room that's worth 1,000, but you only pay 500 for it. So the value of that option is 1,000 minus the 500, so it equals $500 because that is the difference in value between what you actually have to pay and what the room is worth. So that's the value of the option. Let's look at another example. Imagine you could sell your old automobile today for $11,000 if you sold it today. However, you would have use for it, or you do have use for it, and would prefer to sell it 1 year from now. However, if you wait 1 year, the car could be worth anywhere from $6,000 to $10,000. So someone has offered you the right to sell her your car in 1 year for $9,000. But for that right, you have to pay $200. So what's the type of option we're looking at here? Well, what's the right? You have a right to sell the asset. What is the asset? Your old car, and you have the right to sell it. So that would be a put option. Now, what is the exercise price? The exercise price, if you recall, that is how much under the agreement, the option agreement, how much you would be able to sell it for. What's the price that you've pre-negotiated? And that would be the $9,000. So that's the price of the asset, $9,000 that you've agreed upon in the option. The maturity or the expiry, that means how long do you have until making that decision? Well, there we realize that's 1 year. You can decide in 1 year. So that's when the option expires. Now the premium for the option, that's how much you're going to pay for it. And there we have $200. So that's the cost of the option that you pay. Now, regarding some terminology, European options can be exercised only at the expiry or at the maturity of the option, so only when it's due. American options can be exercised at any point in time up to and including the expiry. In the money is a term referring to an option that would have value if you were to exercise it now. At the money refers to an option that would have no value if exercised now, and that's because the spot price equals the exercise price. And out of the money also refers to an option that has no value if exercised now. However, there it's because the spot price and the exercise price are not the same. Now, looking at the call option value at expiry, we're going to design a little equation for it. So we're going to designate S. Normally the S stands for stock because, of course, with call options or any options, in fact, we're usually dealing with shares or stocks. However, there are options on many things aside from shares, but the S normally stands for share. But S of T is the timing, and the capital T means the value of the asset at expiry, so the time when it expires. E is the exercise price, and C is the value of the call option or the option premium. So the equation is C is the maximum of S of T minus E, or 0. And all that means is that the value of the call option at expiry is the difference in price between S of T minus E. And if that value is below 0, then the value is 0, because again, an option will not go below 0 in value, because you are not forced to exercise an option. So the worst that'll happen is, if you're the holder of an option, is that it's worth nothing, you throw it out, you never use it. So let's use some numbers and assume we're valuing a stock option which gives the holder the right to buy a share of stock for $30. The cost of this option, or the premium, is $4. So what is the option value, or the payoff at expiry, based on the various potential values of the underlying share? First of all, we know that if the share price is anything below $30, the value of that option is 0. Why? Because the option gives you you have the option to buy a share for a cost of $30. And so if the actual share price is anything below 30, that option has no value. You can throw it out, it's valueless. It starts picking up value once the share price is anything above 30. And in fact, the value of that option is just the difference between the price of a share, that's the S of T, and $30. So looking at that as a graph, you can see that from a price of anywhere from 0 up to 30, here we have, let me just point out the fact that on the horizontal scale, you have the share price at the expiration or maturity, and on the vertical, you have the option payoff or profit. There's no portfolio in this case. So here we have, from 0 to 30, the option has 0 value when the share is less than 30. And then everywhere that the share is is worth more than 30, the option gains in value. And how much does it gain? Well, 1 to 1. So for example, if the share were $40, then the value of the option is $10. Why? Because it gives you the right to buy a $40 share for a price of 30. So the option itself would be worth 10. So at a price of 50, the option would be worth 20. You get the idea there. And so that's the graph for an option. Now the profit for an option, for the option buyer that we're showing here, is simply the value of the option at expiry reduced. In other words, you subtract the original cost that you pay for it, which would be $4, because initial option premium was $4. So in other words, for anything from 0 to 30, you're losing $4. Why? Because you bought the option for $4, and then it's worth nothing at the end. Now, starting from 30, you start gaining $1 for each dollar that the share price is increasing. So as you can see here, that's where your inflection point is 30. It's basically, if you'll notice, the previous graph reduced by $4, because that's the profit. And as you will notice, the break-even will happen here at a price of 34, because the profit, or rather the payoff of the option, is $4, and that matches the $4 that you originally paid as an option premium. So your break-even is at $34. Okay, thank you for your attention.